Hey traders, Akil Stokes here and welcome back to another Trading Edge video. If you guys are brand new, I'm a Forex trader. I'm also one of the co-founders over at tier1trading.com. And the Trading Edge is a daily video that my partner, Jason Greystone, and myself put out for our Tier 1 members, taking what we teach in the training courses and practically applying them to the live market by showing you guys what's on our radar, what we're looking at, and really the thought process behind our analysis. And this is, well, a weekend version that I do on YouTube. I've been doing YouTube videos for years and years and years. It's something that I truly believe in. It allows me to really give back to those who don't have the opportunity to be on the platform. So it's something I love doing, and I know you guys get a lot out of it. Now, in today's video, there aren't a lot of quality trading opportunities, high quality trading opportunities on my radar. So I wanted to replace that with, yes, looking at trading opportunities, but also throwing in what I believe are some very important lessons. One's going to be on structure analysis and what you should be aware of before taking a structure-based trade. The second is going to be on different approaches to trading advanced patterns. And the third is looking at our trading results and talking about what's really important and really how to squeeze the most out of your trading strategy. Now, before we hop into today's video, it has come to my attention that many of you guys are feeling guilty. As I mentioned before, I've been doing these free videos on YouTube for a long time now, and many of you have reached out and said, Akil, it feels like I'm stealing. You've given so much value, you've given so much content that I can't sleep at night. My conscience is not treating me right. Well, if you feel like that, you should. But I have a solution for you. If you do two things, one being like this video, the second being share this video, I guarantee your conscience will be clear. I guarantee you can sleep at night, and I guarantee you'll feel less awful about yourself as a person. So hit that like button, hit that share button, and feel good about yourself again. I actually just had a cool exchange the other day on Twitter, or Instagram, excuse me, with a trader that was talking about YouTube videos and how everyone talks about, I'm giving you so much value, so you must give me this as return. So this is a little joke. If you guys are new, I have a sense of humor, so I'm not trying to guilt you. Now, if you feel guilty enough to do it, by all means do it. But it's just it's an inside joke with the guy I was talking to on Instagram. Anyway, I hope that was funny. If it wasn't, ignore it. Let's hop into the charts. So we're going to get started this week by taking a look at the euro dollar, really revisiting the euro dollar. And I know what you're saying, Akil, we took a look at this last week and the pattern formation got blown out the water. It was a loser. Why are we looking at it again? We should throw the pair away once it loses and never look at it ever again. Well, unfortunately, the reality of trading is, guess what? Losses happen. And I did take a loss on the bullish Gartley that we talked about last week. However, in the bigger scheme of things, it really didn't make a difference. And we'll talk about that a little bit later when we see this week's trading results. But the fact is, you have to be comfortable losing. You have to understand that every strategy, every system takes losses. And unfortunately, it's those who bail on their system after a streak of losses that then miss the streak of wins and kind of get stuck in that snowball effect of really just slowly bleeding their account. Now, this week on the euro dollar, I don't really have a trading opportunity, but I do have a bit of a warning, and this is a bad habit that many traders do. One of the things we preach here at Tier 1 Trading, you'll hear this preached by basically all serious professional traders. In fact, I can't think of a professional trader that, maybe that's not trading an automated system that doesn't preach higher time frame analysis, and it's going to be a very important example of that. Because if we were to look just here on the 240 chart, the 4-hour chart, what would you be anticipating, right? Price action has broken through the previous level of structure, the advanced pattern formation that we had down here, right? And we're falling, right? You're typically looking for that next level of previous structure support. So you're saying, ooh, look at this. 113 level. That's also one of those psychological numbers Akil talks about. Let's look for a buying opportunity there. RSI is starting to show a little bit of divergence. You can see the slope of the downward move is starting to slow down. So essentially what we're looking at is a loss of momentum coming in the previous structure, which for a counter trend trader or a structure-based trader is the ideal setup coming into that level. However, this is where kind of a bigger picture view comes in handy, because if we were to do this, right, if we were just to bounce out to the daily, right, does that change your perspective at all? Remember that yellow line is that 113 even handle that we're looking at in the 4 hours. Does that change your perspective? Well, probably, because you'll see that although we have structure lows right here, we also have some more structure lows here. We also have more structure lows there. And something that I preach to our members all the time is that when you have these multiple levels of structure, meaning, you know, one on top of the other or one underneath the other, typically the lower one is going to be the more important one. And these are those sneaky scenarios where you do something like this on a 4 hour, right? You enter a trade right here. You put a stop loss right here below structure, feeling good about yourself. Like, oh yeah, stops below structure, stops below the even handle, all that fun stuff. The market ends up putting in one of these type of moves, right, where it comes down and it spikes you up, out, only to continue in your direction, and you get all upset. And then you finally eventually zoom out to the daily, and you're like, oh man, it was this level of structure that held, and that stinks. So one of the ways to combat that, if you're someone that's not using multiple time frames, if you're on the platform, if you're, you know, this comes with our trial membership as well, but use the VS1 levels, because if we're looking back here on the 4 hour chart, you can see these visual green boxes showing you that, yes, this is a nice level of structure, but wait a minute, why is there another green box below it? Oh wait, why is there another green box below it? Maybe I should zoom out my chart and look, or maybe I should go to a higher time frame and just be aware. And sometimes it's that smallest of clue that can keep us out of a bad trading scenario. Now, I'm not saying that you can't look for a counter trend trading opportunity there. I think it does present a very good structured trading opportunity, especially on the lower time frames. But what I'm saying is just be cautious. So being aware that this is not necessarily the main level of structure. Maybe that allows you to act differently with your stop loss, right? Maybe stretch it out some, maybe tighten it up some, saying, hey, I'm willing to take a loss, but I'm not willing to take a big loss. Or maybe even take a less aggressive entry approach, wait for a little bit of confirmation at that level before pulling the trigger. And for you guys that saw my Trading Edge video from Thursday, the one that's on the site, we had a good example of that with, I think it was the CAD Swiss, where just waiting for that confirmation, using those rules can make a big difference in a quality trading opportunity and a negative one. So again, no real trading opportunity on Eurodollar. I guess a structured-based trade down there, it's too early to tell if we're going to get what we need to involve yourself. But I thought I'd kick things off this week by just giving you a little bit of a lesson in structure analysis. And again, these VS1 levels help massively because it's just a little reminder. It doesn't do the work for you, but it's a little nudge in the shoulder like, hey, why is that there? Maybe I should check. Oh, glad I looked at that. Now, speaking of trading opportunities, let's go to New Zealand dollar. There isn't too much that's heavily on my radar here in the markets, but New Zealand dollar is one. And New Zealand dollar has been an interesting pair to really start the year. We're going to go on a daily here. If you've been looking around the markets, you know that there hasn't been, well, I guess it's all about how you define it. But for me, at least, there hasn't been a great amount of quality movement in the market. But New Zealand dollar has been one of those pairs that has given a lot of quality movement. Unfortunately, it hasn't given any quality movement that I can take advantage of. I haven't had a single trade on this pair. So I've just been kind of watching and predicting, but not getting involved. And we do have something. I guess I took one trade on New Zealand dollar. I took one bat this week this week on New Zealand dollar. That was about it. But here's what we're looking at next, right? So you can see here's one of the moves we called in the past. It looks like a pattern formation here, but it's not really one. We did have very close to an AB equals CD pattern at previous structure highs. We didn't quite get up there. And now price action has started to roll over. Now, before we, well, let's talk about this, right? This week coming up on February 12th, right? So whatever date it is, I think it's a Thursday, February 12th. Let me just check my calendar real quick. Tuesday, there we go. Shows how good I am with the calendar. But this Tuesday, we do have some news coming out for New Zealand dollar, right? We have a monetary policy statement coming out, or I guess a monetary policy rate, but there's no expected change, so I don't think we need to worry about that. But we do need to worry about the rate statement and the policy statement, and that can really that can really affect the New Zealand dollar, especially when news comes out during the very thin Asia session. You can see 8 p.m. New York time. And what you would expect from this type of news event is the typical political talk where it's like, oh yeah, we could see some upside this, we could see some downside that, kind of like playing both sides. But there may be a chance that they say things are a little bit worse than what they were beforehand, and that's due to the trade war and all the trade talk that's going on. So if there are any little hints like that there's any type of negative news for the New Zealand dollar, I think we're going to see some continued bearish movement, and we've already seen that in the news we had this past week, and you can see it on your chart here with the big red candles. But if we do get a rally to the downside, right, here's what I want you guys to look for. Yes, there can be a structured trading opportunity right in here, right? But if we blow past that level of structure, the next thing to look for is a potential advanced pattern formation. It's going to be one called a cipher pattern. So again, taking a look at New Zealand dollar here on the daily, if we just bring out our pattern drawing tool here, if we look at this initial move, this is going to be our X to A, right? Our initial pullback is going to be our A to B. This extension up here that came ever so close to being a one-to-one measure move at previous structure is going to be our B to C. And if we rally down to this level right here, about 66.60s, that's going to give us a decompletion for what's called a cipher pattern, which is a bullish potential trading opportunity. So for you guys that are longer term traders that trade this on the daily time frame, and obviously if you're a pattern trader, this is something that you want to have on your radar. Now, here's the cool thing about pattern formations. I think a lot of people that are new to them, and you can trade these things all different types of ways, right? As long as you have consistent rules for it. But I think a lot of people that are new to the concept think that, hey, price action has to retrace right on this level. It has to hit that exact D point and then retrace off of it. And that's not necessarily the case, right? This is the start of our kill zone. So a little bit different than how we draw kill zones and trend continuation opportunities and whatnot, but this is the start of our kill zone. And what we're doing is we're expecting some type of reversal for this pattern formation in this zone. So the level between 66.60s and our X leg right down here at about 65.86s. So there's a wide zone in which you can look for opportunities to get involved in this cipher pattern. Obviously, if you're an aggressive trader, you want to put a limit order there and just say, hey, I don't really care what happens in that zone. Once the pattern is officially completed, I want to be involved. But if you're someone that takes more of a conservative approach, right, you can treat it like any other trading situation where you use that if-then syntax, where if price action comes into my zone, then I look for blah, 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 blah to enter the trade. Now, like anything else, there are pros and cons. There's a give and take in anything you do in trading. What do you guys think would be the positive of just setting a limit order at the decompletion? What would be the benefit for traders that do that? Just aggressive limit order. I don't care what happens. Once price hits that point, then I'm in. What do you guys think? Type it in the chat on your right for you guys that are listening. Or watching the premiere, I should say, not listening, but yeah. Yeah, well, the benefit to that is that you get in. We've seen plenty of scenarios, right? And I always say the good moves don't last, right? Trading is kind of like real estate. The best moves don't last. Price doesn't really hang out at the greatest levels for you supply and demand traders. You notice to a T, they kind of hit it and reverse right away. We see those V reversals. So if we're going to, if you're someone that uses an aggressive approach and price action does something like this, where it comes here and just shoots right up, well, guess what? You're in the trade. Right? And we actually saw that. If I just bring over another chart for you guys that traded the pound yen this past week, which is the trade I got fired up on. It's a funny story. We had you can see it here in my chart. We had advanced pattern information here on the pound yen. And this was a maximum risk trade for me, meaning that I actually had to enter the trade a little bit lower than I usually would because the stop loss was so big. And it was one of those trades that we hit it. We're talking about something in the live room, probably some nonsense, right? And I'm watching it, and all you hear is, "Wah!" And they're like, Coach, did you just get excited? Because typically I'm, pretty laid back and cool and a smooth operator. Right? Coach, you just get excited? I'm like, no, me? No, I didn't get excited over that 124 pip win. No, it's cool and all, but I honestly did get excited, and it wasn't necessarily the fact that it won. I mean, that's great. I'd be lying if I didn't say I was excited about that. But more so was the fact that it allowed me to really reduce my risk. I don't take a lot of max risk trades. The pound yen is one of those pairs that I have to because it has a pretty good ATR. That's why we call it the beast. Big wins and big losses. But I was happy about reducing my risk, right? I don't like max risk trades because they can put a big dent into my equity curve because they're kind of not the norm per se. So to be able to reduce my risk and be in a pain-free zone, if not a risk-free trade, that's big for me. And again, my number one rule in trading, or my number one kind of approach, is risk management, risk management, risk management. But you see in this example, right, for someone that was a conservative trader, probably never got a chance to get involved, right? This kind of candlestick wick right here, we can even go down one time frame lower, that was the fill. Right? That was the fill. Price action literally came down to the entry right around here, right? Filled it, spiked past by a little bit, and then rallied straight to target ones, right? Didn't look back. So an aggressive trader would have had the opportunity to get involved in this. A conservative trader probably would have been waiting for something and never got it, right? So that's the pro of taking an aggressive approach. The cons, right? The negative, what do you guys think the negative side of that is? Well, the negative side is the exact opposite, right? If price action were to just come here and say news comes out or the day after news or whatever and just blows right through for whatever reason, guess what? The person that took the aggressive approach, they're in the trade. They took a big loss. For the person that was waiting for confirmation, they never got involved because the market went right through and never gave them the entry signal that they needed. So I'm not saying one is better than the other. They both have pros and cons. For the conservative trader, they'll miss the move that goes right away. They'll also miss some of the losses. For the aggressive trader, they'll catch the move that goes right away. They'll also catch some of the extra losses. What's important is that you mesh your trading to your personality. I know a lot of people don't believe that because they're like, well, you should just trade whatever's most profitable. People that say that actually haven't been in the trenches. When you're in the trenches of the market, trading live money, dealing with live emotions, dealing with real pain and real greed and real fear, having a firm grasp on your trading psychology is everything. And it's very, very hard to have a firm grasp on something if you don't truly believe it, if it doesn't really mesh with your personality. So I always think that's important. But that's what to look for here on New Zealand dollar. Again, we do have news coming out on Tuesday, so you want to make sure you watch for that. Another pair, I'm kind of all over the place today. Again, I didn't have a lot of great opportunities on the radar, but there were a few. One was the Euro Yen. Euro Yen is a cipher as well. We can talk about it. I can't take this. I'm already in a trade on Euro Yen, but I'll show you guys the cipher here. I took a structure-based trade on Thursday. It was right at the level higher than this. I'm probably going to lose this trade. I haven't been stopped out yet, but I'm probably going to lose. And I don't say that just because I have a negative attitude, but it's just based on the technicals. But I had to make a decision whether if I took that trade because my stop loss is beyond the cipher completion, it had to be one or the other. I couldn't take both. And, you know, my philosophy is simple, right? I always take the first valid signal. I'm never going to pass up on a valid signal for a potential signal because, right, if I'm right at this situation, guess what never happens? That potential signal. And I don't want to sit there foregoing a trade, right, and what would have been a winning trade, assuming it went up, waiting for a potential trade. So I take the first signal. I took it. Again, probably going to lose. It may not lose. Maybe the cipher will hold and I'll be able to make a little bit of money off of it. That'd be great. But I am unable to take the cipher, but it still is a valid cipher completion. It's going to be at market for the open. So if you're a cipher trader that plays this on, that trades the Euro Yen on the 240 chart, something you want to have on your radar as the markets open this week. I feel like there was one more, right? Very unorganized today. I spent all day yesterday in New York and got home very, very, very late. So a little bit off my game here, but let's talk about gold. Gold was another option. And this was one that we looked at earlier in the week in our Trading Edge videos. And we're looking at, I'll give you guys kind of a brief rundown of gold, a brief review. But if you guys that are on the platform, you can go back and watch Tuesday's video. But essentially, gold was trading in between two levels, right? We had rallied up to this level as previous structure resistance and held. we had just broken this previous level of structure resistance, right? So we're kind of stuck into two areas. And I said, well, we might see some type of channel in here, right? We might see some type of consolidation similar to what you see to the left over here. And as we went down to the lower time frame, we're looking for a potential reversal pattern within this zone. This line was actually a little bit higher there. And what we had was a head and shoulders pattern, right? We had something that looks like this. If I just draw it out, right? Price action rallied up, boom, retracement, head, retracement for the neckline, right shoulder, and obviously for, maybe not obviously, but the completion, the validation of the head and shoulders pattern is the break of that neckline, which you can see happen right here. So what we've done now is we've pulled back, right? And that's one of the techniques I teach. That's my preferred technique for trading head and shoulders. It's more of a conservative approach, but as you guys see, I'm more of a conservative trader in the bigger scheme of things. But one of the techniques is waiting for a pullback. We had our initial pullback here. We didn't really get any legs off of that. And what we're doing is we're putting in a complex pullback here, which is essentially an AB equals CD pattern, a two-legged move. There's a video for you guys that aren't familiar with ABCD patterns. There's a video here on my YouTube channel recently, meaning within the last month, I believe. I'm teaching you guys that, so you can go check it out. But we're putting that right back into the right shoulder. For you guys that are fans of the RSI, what else do we have here? We've got some hidden divergence there, which is typically something that goes along with a trend trading opportunity. So this is an opportunity to get short. If we're measuring out risk reward here, right, for a short position, obviously you want to wait for your reason for entry. I'll leave that up to you guys since it's going to be different per trader. But let's just say you get involved right here. Stops need to go above the right shoulder. Targets can go at a retest of previous structure lows here. Secondary targets can go a little bit lower as well. This was the main level that I had on my radar. I'll drag this line here. So I'd probably just take a one in, one out approach. I'm not too sold on a continuation down to this lower level of structure. So I'd personally, if I were trading this, I'd take a one in, one out approach just at previous structure lows, just because there's not real clarity in the situation. Again, higher time frame, we are still trading in consolidation. So although this is a reversal pattern, I'm not quite sold on a long-term bearish reversal, just kind of a simple short-term market can't make up its mind type reversal before we get back to business one direction or the other. But it still was a quality trading opportunity. You can see the risk reward can be pretty decent as well. So that's what's on my radar for this week. Let's talk about a little bit about last week's trading, right? Last week's trading, right? If you guys have been following along, and I hope you have, you know that we ended with another hot streak, right? It was a very positive January for me. Maybe the market gods are getting back at me for the, or I guess maybe karma, I should say, is returning the favor from the 17% drawdown I had 2 years ago in January. But it's been a very positive start. But one thing I have mentioned is that I'm really outpunting my coverage. And essentially what that means is I'm outperforming myself from a win percentage standpoint. I was hitting at about 70 something percent to start the year. Typically I am about a 55% trader. And what I was expecting was kind of a move back to the norm. So I was expecting a drawdown to come. And we've seen that a little bit this past week, where I've taken 4 trades. Again, there's one still in progress on, well, actually there's 2. There's a pound yen trade that's still in progress, which if that were hit target 2s, that would be a massive winner. There's also the euro yen that is in progress, which I'm going to assume is a loser yet, but it hasn't lost, so I haven't put it in my spreadsheet. But I'm going to assume that's going to lose. But aside from that, it's been about a 4 trade week, 2 wins and 2 losses. Again, 2 wins and probably 3 losses. And this is where risk reward comes into account, because if you look at my 2 losses, right, 36 pips and 52 pips total when you calculate both positions, right? So about 88 pips. Again, let's even count the euro yen loss. I'm gonna go ahead and put that in here. Stop loss 124.12. Let's just say that's a loss. I'll delete this later. I don't do this usually. I don't write losses into they're actually losses, but just to give you guys an example purpose here. 124.12 on both positions, right? So that's going to be another 94 pip loss. So let's look at those two together. Let's call 94, let's say, 86. 86 plus 94. Who can do some quick math for me? 86, 94. I can't do it on the spot. I would usually use my fingers, but let's just do it here. 86 plus 94, right? But I was going to say that. Look at that. I was going to round up to 180 and got there anyway. So 180 pips on the 3 losses total this week. However, you take a look at the two winners, and again, one is still, this could still end up being even bigger, but even right now, the 2 winners right now, 290 pips, right? So 2 winners, 290 pips, 3 losses, 180 pips. It's risk reward, guys. Again, I want to come in and preach each and every week how unimportant win percentage is. And it's not, not important at all. You need a win percentage. If you win 0% of the time, there's no way you can possibly be profitable. But the message I want to get across is you don't have to be so hung up over your win percentage, right? That's not how you should be judging yourself. You should be judging yourself on your P&L. Right? And really, if you have the right philosophy, you should be judging yourself on the steps needed to create that P&L. So the process over outcome. But the more you judge yourself on win percentage, the more you're going to get, you're just doing yourself a disservice, because you're in an industry where the best of the best lose a lot. Right? It's very similar to a professional baseball player, where you have your Hall of Fame baseball players, right? Your Hall of Fame baseball players failed to get a hit 7 out of every 10 times they were at the plate. Right? Now, do you think they get depressed? Oh man, I only got a hit 3 out of 10 times, right? I got out 7 times out of 10 times. They get depressed and they're losers? No, because they know that in that industry, in that sport, baseball, a 30% or 300 batting average is great. Right? And it's the same thing in trading. Now, obviously, your win percentage is going to be based off your strategy. I'm not saying you can have a 90% win percentage. That's fine. But you have to know what your norm is. And when I come in each and every week and I tell you guys that, hey, 55% is my norm, that allows me to be comfortable. That allows me to know that, hey, if I'm anything over 55%, I'm doing better than expected. If I'm anything under about 45%, that's kind of my floor when it comes to win percentage, then something's wrong. But as long as I'm operating within that area, I'm comfortable. And my number one goal isn't to win more, but it's to keep my winners bigger than my losers. Keep my winners bigger than my losers. Because if I can keep my winners bigger than my losers, I can win at a 50% clip and still make money. I can win less than I lose. Yeah, we can win less than I can win less than I lose and still make money as well. And the result is what's important to me, not the ego of saying, hey, I win every time I trade. I'm too old for that, right? I'm a grown man. I don't care about ego and pleasing others, right? I care about my bottom line, what pays the bills. So I'm going to keep preaching that message and bashing it over the head until all of you guys accept it. And if you don't accept it, well, then that stinks for you, because you got to accept it. But again, it's not the number that matters. You don't have to be a 55% trader. I'm not telling you to be a 40% trader. I'm telling you to know your number. And your number should be based off your strategy, which is based off of your back testing, and become comfortable with that number and then work on the other things. Don't necessarily try to go from 60% trader to 80% trader. That's a big jump. Probably won't be able to do it. Be comfortable with being a 60% trader, and then ask yourself, okay, well, how can I squeeze more out of the 60%, right? Working on maximum favorable excursion, maximum adverse excursion, which are probably words I shouldn't use in a YouTube video, but essentially that means, how can I get more out of my winners? How can I maximize my winners without kind of being too greedy and having it go against me? And how can I tighten up my losers without being too kind of aggressive and not giving the market enough room to breathe? And those are the key facts in what makes you a successful trader. And obviously for newer traders out there, it's eliminating those mistakes as well. So I hope you guys enjoyed today's video. Again, let me know what you thought below about the lessons, or if you're struggling with any of those aspects. As always, the best way you can support what we're doing here is by liking and sharing. Word of mouth is really our best form of marketing. We're not too big on marketing strategy and advertisements and stuff like that. Rather, we like to let our product and our personalities speak for themselves. So many of the members that have come into our Tier 1 trading platform, whether it's a trial member or a premium member, they've come because they've heard from someone else that, hey, this is a great place to be. It has really improved my trading. And I just think that is the best form of marketing, instead of kind of just selling you on why you should be here. You should come here because of this, right? Letting the people that actually do it speak for us is the #1 way. So every time you like, every time you share, it helps us do that. It helps us bring new members in, helps us take newer traders, get them on the right path, and hopefully progress them on achieving their life goals. And that's what we love. That's what we do it for. So until next time, plan your trade, trade your plan. Premium members, I'll see you in Monday's Q&A. Got a few questions already. Haven't looked at them, but we're on a massive heater when it comes to quality Q&A, so I'm excited for that. And for you guys that are watching on YouTube, I'll see you next week, hopefully. If not, maybe the week after that. Hopefully, we'll see. Anyway, plan your trade, trade your plan. You guys have a great weekend.